Hi, this is Alan Moore, Certified Financial Planner and founder of Serenity Financial Consulting. Thanks for joining me. Do you know how your investment advisor gets paid? This is a topic that as a financial planner, I feel like we have beaten into the ground. It is probably the most widely written about topic by financial planner bloggers, and yet it is still something that most people cannot answer. There's a lot of confusion among investment advisors on the different pay structures, so you better believe there's a lot of confusion among consumers. And this confusion, I believe, has led to an immense amount of distrust for the financial services industry. I want to outline the two primary ways that investment advisors get paid, and then explain a third way that's more of a hybrid model that has probably introduced more confusion into the industry than anything else. The first way that advisors get paid is by commission. So these advisors are paid whenever they sell a product, and they are paid a commission by the company whose product they sold. So for example, if a commission advisor sells a mutual fund, let's say to a client, and it's a $100,000 mutual fund, they will be paid, let's say 5%, so $5,000 by the company to sell that product. This 5% is deducted from the client's investments in the form of a sales load. Now this sales load can come when the client buys the product, it can come when they sell the product, or it can come on an annual basis called a flat fee. But one way or the other, the commission advisor is being paid that sales load. The second primary way that advisors get paid is called fee only. Now fee only comes in a couple different forms. It can be on a retainer basis, it can be paid hourly, or the most common way that fee only advisors are paid is an assets under management charge. Now this is maybe a flat fee percentage. Most common is probably 1%, it's kind of the industry average, on the investments in which they manage. So each year, 1% of what they're managing is being paid to the investment advisor. The third way is called fee-based. Now this is the hybrid model, and fee-based sounds a lot like fee-only, but it is not the same. It is so important to know that fee-based, the differences between fee-based and fee-only. Fee-based is both commission and fee-only. Okay, these advisors are duly registered with both FINRA and the SEC. FINRA typically regulates the sale of products. The SEC regulates the giving of investment advice. Now, so these fee-based advisors will charge a commission on the sale of financial products, and then will charge a flat fee for advice rendered. It can be kind of confusing as to, are they selling a product or are they giving advice, and it's really a conversation for a future post. But the fact is that the fee-based has caused a lot of confusion because it sounds a lot like fee-only, but it is very, very different. So potential clients will sometimes ask me, why should I pay you for the services that my investment advisor is doing for free? The confusion comes because they don't actually see the commission sales load that are being paid to their commission advisors. It's being deducted in the form of the sales load and not a check that's being actually written to the advisor. But I can guarantee you, one way or the other, your advisor is being paid. So what do you think? Do you know how your advisor is being paid? Have you ever asked? Ever get an interesting answer? Feel free to share below. Thanks for joining me.